Welcome to the Organized Expat, brought to you by Tytle, the platform for expat taxes.
Laurens, what are we going to talk about today?
Right, so we're going to talk about people who live in Portugal or people who are looking to move to Portugal and still have a company abroad and the tax consequences of that, because we often get questions from people who mostly are looking to move to Portugal and they want to keep their company abroad.
Yeah.
But that's not as easy as it sounds, that you can just keep your company abroad, move to Portugal.
Because you can either keep it or you can dissolve it and start with a new company in Portugal. But here we're going to talk about what happens if you maintain your company abroad and you move to Portugal.
Yes.
So first of all, income from such a company, what happens with that income?
Yeah, it depends a little bit because the company is still, in our example, is still located abroad. Let's say, just for this example, in the United Kingdom. So Portugal will not have direct taxation rights, corporate taxation rights over the company income in the UK.
Because that's always in the company or always in the country where the company is located.
Exactly.
Yeah.
So in the UK will have those taxation rights.
Yeah.
One risk, however, is if you move to Portugal and the company is still in the UK, but the effective management of the company, let's say if you're the only director and you move to Portugal and you just fully live and work in Portugal and the company is only in the UK on paper, then it could be the case that under, let's say, corporate residency rules, that Portugal says that that company has moved with you to Portugal.
Yeah. Because you're the management, you're the effective management, you're the only management, so if you move to Portugal, then the whole company moves to Portugal.
Exactly,
for tax purposes.
Yeah, and at least theoretically under corporate taxation rules, corporate residency rules, because we often talk about tax residency for individuals, but tax residency is also a thing for corporate entities. So if you have a company, that company also needs to be a resident somewhere.
Yeah,
so
exactly.
that could be in the UK. It will still be the UK on paper, let's say, unless proven otherwise. But if you move to Portugal and everything, all the strategic decisions, everything is managed from Portugal, then it should be relatively easy even to figure out for the tax authorities that that company is fully led by you in Portugal.
And therefore has become a Portuguese company because the effective management, location of effective management is decisive.
Right. So you have to often look at the location of effective management and control, let's say, from the company. Where is that? Is that in the UK or in Portugal? And if that moves to Portugal with you, then you can have all kinds of consequences. Even people with NHR, you can say, okay, the company is now a Portuguese company, so that whole NHR...
it doesn't apply, of course, because it's no longer from abroad.
It's no longer a foreign company, a foreign company, so no longer foreign-sourced income.
Yeah.
So that could be jeopardized, for example, if you had thought of a tax setup that way. Of course, any other unforeseen things.
But there are two things we could talk about. So first is profits, and profits are taxed, just corporate taxation in the country where the company is located. In our example, that is the UK, but if you move to Portugal and you're the effective management, that could move to Portugal as well.
Exactly.
But let's say that the effective management is still in the UK and you move to Portugal, but you're not the effective management, so you don't take the whole company with you, but you still receive salaries or dividends from the company. That's of course something else and something different from corporate profits. So what happens with salaries and dividends?
Right, so salaries, and you have to look at the tax treaty. So you have a foreign company where you receive the salary from, but let's say if you live and work in Portugal, you work every day in Portugal, then that salary should be fully taxed in Portugal. If you, for example, spend 4 months in the UK, and it could be a split, so 8 months basically 8 months taxed in Portugal, 4 months in the UK. So that really depends on where you work, where you perform the work, facts and circumstances. Dividends, dividends in general. So without NHR, dividends would be taxable in Portugal. The tax rate is 28% there. It could also be that abroad there's a tax rate on outgoing dividend payments, and then you look at the tax treaty, and that percentage always has to be lowered, for example, to 5%, 10%, or 15%. That depends on the tax treaty. Now with the UK, which was our example, I believe they don't even have a tax on outgoing dividend payments. So that's why that was a popular one to live in Portugal, have a company in the UK, then get dividends from the UK because there was no tax on outgoing dividend payments. And in Portugal, it was exempt under NHR.
So no taxation then, zero taxation.
Yeah, exactly. But then you still have to look, okay, but is the company factually in Portugal or in the UK? And then you can look at, okay, where's the effective management, the control of the company?
But going back one step, so you say that, just ignoring NHR for the moment, dividends, often you see that they are taxed in the country that sends the dividends abroad, so that's the withholding tax on the outgoing dividends. And then you often see that also the country that receives the dividends, so if you live in Portugal and if you get your dividends in Portugal, then you see that Portugal will also tax it. So both countries often tax it.
Right. Yeah, so in Portugal it's taxed because you live in Portugal, worldwide income, so it's just added to your taxable income, let's say. So you get a dividend, then you report it. Let's say without NHR you would have to pay the 28% tax rate. It could be that the other country also wants to tax it. Let's say it's 40%, for example, but then that other country, on the basis of the tax treaty, needs to lower that withholding tax, for example, to 5%. It depends on where that other company is located. And then you effectively pay 5% abroad, and 28 minus 5 is 23% in Portugal.
Okay, so you can deduct the withholding taxes that you already paid, that were already paid on the outgoing dividends. You can subtract that, deduct that from the rate that you pay in the country where you are tax resident.
And that always depends on where do the dividends come from, what's exactly in the tax treaty.
So and theoretically speaking, it could also be that it's 10% on the outgoing dividends. It's normally 20% in the country where you live, but because you already paid 10% on the outgoing dividends, it will be another 10% and not 20%.
Indeed, effectively speaking, that would be the case.
Okay, that's all clear, I think. How do I avoid, I'm just going to the next question because we still have quite a few. How do I avoid my foreign company being taxed as a Portuguese company? I think we already touched upon that.
But I mean, it's, so if we have this company in the UK, you move to Portugal, and you want to basically prove that the effective management of the company is still in the UK. If you're the only director, that could be tricky. So then you could, for example, we could recommend having a clear paper trail of strategic decisions, management meetings and everything, showing that those are all taken in the UK and that it's actually, factually speaking, that there is, that the management, effective management of the company, that is taking place in the UK as well, and not just on paper, but factually speaking. Then also, of course, if there's a UK-based director at the company, that's also a strong indicator that the company still is a corporate tax resident of the UK. So if, for example, there's a 3-person board and still 2 of them are in the UK, or even a 2-person board and 1 of them is in the UK, that makes it easier to prove that the effective management of the company is still in the UK.
But this really depends on facts and circumstances, whether you can prove that the effective management is still in the UK, if you want, of course, that the company is still in the UK. So, but that's something you should keep track of, that you should be able to prove upon request. So it's important that you have, let's say, enough evidence.
Exactly. And in the tax treaty there are also, of course, tiebreaker rules. And in case there's this dual residency problem, and then the tax residency, let's say the tiebreaker, is clearly outlined in the tax treaty between Portugal and all other countries. And there you can see basically a decision tree that helps you see what the company's main tax residency is.
Okay, so you can always look at the double taxation agreement to see how to determine residency also of companies.
Yeah.
Yeah. What's the impact of NHR, the NHR regime, the non-habitual resident regime, which, by the way, does only exist in a new shape, 2.0. There's another video we have on that. So it's not, let's say, you're not eligible as quickly anymore as you used to be. So, but let's say you have this NHR regime that applies to you, income from a foreign company, what happens then?
Yeah, right. So if you get a dividend from a foreign company and you have NHR, then that dividend is typically exempt in Portugal if it's with a country, if the paying country is a country with whom Portugal has a double taxation agreement.
Okay.
And then there are certain countries that are more beneficial than other countries because their rate on outgoing dividend payments is lower. Yeah. So for example, the United Kingdom.
That's called the withholding tax.
The withholding tax, exactly. Yeah.
So you only pay the withholding tax in that case, and you pay 0 in Portugal. Yeah. That's, of course, could be a huge reduction because I think very often you see rates like maybe another 10% that you would pay in Portugal, or even another 18%, so that could be quite significant. What happens if my company pays me dividends?
As in that's basically a bit as the previous question. If you have NHR, if you don't have NHR, and you get a dividend and you live in Portugal, then you have a dividend tax, 28% again. If the company, let's say if the company from another country, if there's a withholding tax on the outgoing payment, you can subtract that from the taxes in Portugal. Yeah. It's either a credit or an exemption. It depends a bit on what's exactly in the double taxation agreement.
Yeah, so that's basically what we covered in the previous question. But because it's quite complicated, this stuff, it's always good to maybe to repeat it. But I think by now it's quite clear. And if not, of course, you can always go to our website or ask for help. We're happy to assist. So please go to Tytle.io if that's needed. Last question before we conclude this episode. Are there benefits to relocating your company to Portugal?
Yes, and the benefit is the simplicity of it. That you make your whole tax life simpler, because otherwise you will have to do filings and all in that other country. Yeah. You will still have to think about that. There's automatically a cross-border thing. So if you don't have a clear reason to keep that company abroad, also because tax authorities are likely to challenge it. If you are the only director and you move to Portugal, then it's maybe just as easy to start a company in Portugal or start a freelancing activity in Portugal. If under NHR your agreement, let's say, is very beneficial with that foreign company, and the company is also actually located abroad, so the strategic decisions, management, maybe another director are in that other country, then it could of course be beneficial to keep the setup that way. So it depends a bit on your situation. We normally say if there's no big reason to keep the company abroad and you stay in Portugal long term, maybe just start a company or a freelancing activity in Portugal.
For the sake of simplicity.
For the sake of simplicity.
Yeah, that's a good piece of advice, I think. And also here in Portugal, you have the simplified regime for self-employed professionals, lower corporate tax rates for small businesses. Yeah. So it could even be beneficial to just relocate to Portugal, not only for the sake of simplicity, but also if you look at the tax rates.
Exactly. Yeah.
And okay. Thanks a lot, Laurens. Very clear. Let's go on, talk a little bit more about Portugal in the next episode.
Yeah.
Bye-bye.